Hi everyone, welcome to Invest to the Moon, where I share with you the best tips and strategies for investing your money wisely. Today, I'm going to talk about a book that changed my perspective on investing and helped me achieve better returns with less risk and hassle. The book is called The Little Book of Common Sense Investing by John Bogle, the founder of Vanguard, one of the world's largest and most respected investment firms. In this book, Bogle explains why the simplest and most effective way to invest in the stock market is to buy low-cost index funds that track the performance of the entire market. He shows how index funds beat most actively managed funds that try to pick individual stocks or time the market. He also reveals how index funds save you money on fees, taxes, and commissions that can eat up your returns over time. So what are index funds and how do they work? Index funds are mutual funds that hold all or most of the stocks in a particular market index, such as the S&P 500, which represents the 500 largest companies in the U.S. By buying an index fund, you are essentially buying a small piece of the whole market, and you get to enjoy the benefits of diversification. Which means you reduce your risk by spreading your money across many different companies and sectors. Index funds are also passive, meaning they don't try to beat the market by actively buying and selling stocks based on predictions or opinions. Instead, they simply follow the market as it goes up and down over time. This means they have lower costs than active funds, which charge higher fees for their managers' expertise and research. These fees may seem small at first, but they can add up to a huge difference in your returns over the long term. For example, let's say you invest $10,000 in an active fund that charges 1% per year in fees and has an annual return of 10%. After 50 years, your investment would grow to about $1.1 million. But if you invest the same amount in an index fund that charges only 0.1% per year in fees and has the same return of 10%, your investment would grow to about $1.7 million. That's a difference of $600,000 just because of fees. Another advantage of index funds is that they are tax efficient, meaning they generate less taxable income than active funds. This is because index funds trade less frequently than active funds, which means they incur less capital gains taxes when they sell stocks at a profit. Capital gains taxes can also reduce your returns significantly over time, especially if you are in a high tax bracket. So how do you choose an index fund? The most important thing to look for is the expense ratio, which is the percentage of your assets that goes to pay for the fund's operating costs. The lower the expense ratio, the better for you. You can find this information on the fund's website or prospectus. Another thing to look for is the tracking error, which is how closely the fund matches the performance of its underlying index. The lower the tracking error, the better for you. You can find this information on websites that compare different funds, such as Morningstar or Yahoo Finance. Finally, you should also consider your asset allocation, which is how you divide your money between different types of investments, such as stocks and bonds. The optimal asset allocation depends on your age, risk tolerance, and financial goals. In general, younger investors should have more stocks than bonds in their portfolio, because stocks have higher potential returns but also higher volatility. Older investors should have more bonds than stocks in their portfolio, because bonds have lower returns but also lower volatility and provide more income. Bogle recommends a simple rule of thumb for asset allocation. Subtract your age from 100 and use that number as the percentage of stocks in your portfolio. For example, if you are 40 years old, you should have 60% stocks and 40% bonds in your portfolio. Of course, this is not a one-size-fits-all formula, and you should adjust it according to your personal situation and preferences. So there you have it, a summary of The Little Book of Common Sense Investing by John Bogle. I hope this video has inspired you to start investing in index funds or to review your current portfolio and make some changes if needed. Thank you for watching this video and don't forget to subscribe to my channel for more investing tips and strategies. And remember, the best way to guarantee your fair share of stock market returns is to invest in low-cost index funds and hold them for the long term. Happy investing!